Hello everyone and welcome to live market analysis with me, Jan Mota, Chief Market Analyst for TIOmarkets. And it is my pleasure to spend the next hour or so with you diving into the markets. And it's an important day today. We have the FOMC meeting tonight, or it's actually going on, but we have the press conference and the statement tonight. So we want to know what's happening with these big markets, where the key levels are and how the markets are moving and where they might move to under different scenarios. So just before we move forward, I would like to just draw your attention to this. Our VIP account offering is absolutely great. We have 0 commissions per lot at the moment. There's no monthly subscription fees anymore. They have been scrapped. And there is an offer going on at the moment. If you go to TIOmarkets.com/contact here's the URL, go and ask more about this. I've been trading with this and it's absolutely great. So let's bring up the first charts here. I'm going to look at several markets: dollar index, Euro USD, gold, USD yen. And if you have some other markets in mind, please let me know. Okay, Asim is asking for tips for trading psychology. Yeah, that's a very important and interesting topic. So if you have any specific questions, because obviously covering trading psychology as a topic is going to be a little too wide for this. So let me know if you have a specific question on that, and we can certainly cover this. So meanwhile, let me bring up the first chart here. So here we go. As you know, we often talk about the markets, and we kind of talk about the markets as they would be kind of individuals that aren't related to each other. The fact is that they actually are. You can see that after you've been trading for a while, you can see that there is actually quite a few markets are quite correlated. And if there's something happening in the markets, like take 2008 was a great example, then the correlations tend to go to 1. So that means that most markets move simultaneously up and down. But obviously all the markets are still individuals in a sense that they behave slightly differently, but they have certain characteristics that we need to pay attention to, and they have certain correlations. So I'm saying this because we need to understand that most often we are trading against the dollar. So whether we are trading the S&P or NASDAQ or oil or Euro USD or gold, most often we are trading instruments that have the dollar on the other side. So if we buy gold, then we are effectively selling the dollar. So in that sense, we want to be long in gold when we believe that there is weakness ahead in the USD. Okay, Gideon is asking if we look at NASDAQ. Yeah, sure. Let me make a note of this so that I won't forget. So we are going to cover NASDAQ also. Sure. Very good. Thank you, Gideon. And then, yes. So what can we see here in this chart? First of all, before we do that, I would love to see how long you guys have been involved in the markets, how long you have been trading. Just put a number of months or number of years into the chat so that I have a rough idea on what kind of people I'm talking to. That would be really helpful. Thank you, guys. Okay, cool. Let's move on. So as you can see with this DXY chart, the market was trending lower, and since May, hard halfway through May, the market has been moving higher. Since the 17th, let me see exactly the date here. The low was on 25th of May. Okay, we have René, who's been trading 8 months, Gideon 1 year, Charles 2 months, Marlon more than a year. Excellent. Thank you, guys. This helps me a lot because now I know how to tune my message and maybe explain a little more in terms of what's happening with the market. Asim is saying, have followed signals, but always wanted to do this myself instead. And that is a very important point, Asim. I mean, if you are following somebody else's signals, in effect, you are dependent on that person. Right? Even if, you know, most of the time signal providers are not very good in my experience, just because they are just ordinary traders who aren't very good themselves. But even if you find somebody who's excellent and you follow him or her or those trading signals, then it means that you are dependent on that person. If for any reason that person isn't available to provide the signals tomorrow, then you are stuck. So it's much better to learn to study the markets and understand the markets on your own, and then you can actually see if the signal is good or not as well. Okay, so there's 2 aspects to it. So as we have some new people here, just very quickly, every bar here or every candle represents 1-day price action. And when you can see the market, I have colored these green and red just to highlight, just to give some color to my day, really. I used to have them in black and white, but it's nice to have the red and green. Reminds me of Italy and all the lovely food and sunshine over there. But anyway, so the market was trending lower, and you can see this from the fact that we had a series of lower lows and lower highs. So we have a low there and another low here, and each time the market tries to rally, the sellers, they come in at resistance areas like here, and they force the price down again. And then what happens? Then the market creates a new low. So this is what's meant by me also and many other analysts when we talk about the markets creating a series of lower lows and lower highs. So there's the lower high, and here's a lower low, and then another lower high and a lower low. But there has to come a time when this changes. Yeah, so this is dollar index in daily time frame. So there has to come a time when the trend is over. It basically often happens when the market approaches a support level. Like here, we can see that the market came to this support, and that's when the buyers started really getting interested in the dollar. Now the market has rallied a little bit, and it's not moving below the 20-period moving average anymore. So this here is 20 periods, and I'm using the closing value, just the standard setting here. It's a simple moving average. And for those who don't know how these are calculated, it's just the latest 20 closing values divided by 20. So that's how this line is plotted. And the other one here is 50 periods, just basically the same method there. When we have the red below the blue and the market below the red, we know that there's a strong momentum to the downside. When the market starts to move above the moving average, then we know that we have something is changing in the market. And that something is that the buyers are stepping in. So the way we analyze this is often, you know, different people have different methods, but I'm going to give you some ideas on how I do this on daily basis. As you might have seen my analysis in TIOmarkets.com/analysis, and I'll just type it here. Maybe where's the text? Text there. So TIOmarkets.com/analysis, and you can find daily analysis on this site. I publish it every morning. There's something about fundamentals and also 2 or 3 markets usually per day that are either interesting or they seem like they could provide trading opportunities. So yeah, go there, check it out, and I'm sure you find it helpful. But this webinar should help you to understand how I do my analysis. Those of you that have been following it for a while, they know that quite often I get my analysis right. It's the market moves the way I have been anticipating, and then this obviously means that you can learn how to do good proper analysis, and you can incorporate that into your own analysis, but it also helps you in your trading. But because we don't give any investment advice, like in this webinar also, I should mention that we don't provide, excuse me, it's basically we don't provide any investment advice, and that's something that I need to really display here. Sorry guys, I forgot this, but very quickly take a screenshot of this, or if you're watching the video afterwards, read this on your own time, pause the video and read it. But you should only attend this webinar if you agree with the fact that we don't provide any investment advice, and nothing in here is investment advice. It's just marketing material and educational material. Very good. Okay, let's go back to the chart. So the way I'm looking at the market is I start often with Fibonacci retracement levels, and because they are called retracement levels, we start from the recent high or low. If we want to understand how much the market has retraced from the latest low, we draw the levels from top to the bottom, and that gives us that basically tells us what the others might be looking at as well. Sorry, my voice is cracking. Okay, hopefully it's better now. So this basically tells us that market has been moving back. It has retraced about 23.6%. And you can see that when we came back to this level the first time here, the market was rejected. The rally was rejected very quickly. The second time and the third time, the market has been able to stay at this level a little longer. So it basically suggests that people aren't so eager to sell the dollar anymore. And another way of looking at this is support and resistance levels. So let's just make sure this line is horizontal. There we go. And like I told you earlier, the market has a tendency to find a resistance and honor resistances in a downtrend. So that's one. There's another. And then I would say coming down here, it's getting messy because of the sort of balance in supply and demand. This was penetrated, this resistance. So the message here is the market is not that eager to just fall off from resistance levels anymore. It's probably a little more undecided of what it's likely to do. And when the market is moving sideways like here, that's what it tells you. The market is undecided. It doesn't really exactly know what to do. When the market is trending strongly down or trending strongly higher, then there's a clear bias. Then you have more buyers on one side or more sellers on one side. But now we are a little undecided. And really the reason is the Fed. The Fed has been saying the inflation is transitory. We don't want to start tapering the QE, the bond buying program. We just want to keep it as it is. And the markets, the reason the markets have been a little bullish on the dollar, or less bearish, I should say, on the dollar, is the fact that they have been kind of guessing that the Fed, because some of the items, some of the materials, like lumber or copper, they have risen big time over the last 12 months. So the market participants have been thinking, okay, there's so much inflation that the Fed might have to start tapering their QE. Basically, tapering QE means that they don't buy as much as they used to. The Fed is keeping the interest rates down by buying treasury bonds, the US sovereign bonds. And if they stop buying or reduce the buying, then the value of the dollar will go higher. And this is what the markets have been thinking here, that yes, maybe this is the time that the Fed really has to start act sooner than expected. And this is the focus today. The markets participants want to know if the Fed, the Fed bankers, the Fed officials have been amongst themselves, been discussing the tapering, whether it has been only one person or two persons or more, whether it's been a widespread discussion. And that really impacts how people see the dollar future, the future of the dollar, the near-term future. If you think about what's happening with the fundamentals at the moment, I think we all can say that the worst is over when it comes to the pandemic. Who agrees with me? Let me see. Let me see in the chat. Do you agree with me that the COVID-19 pandemic is, especially in the US, because that's where the Fed operates, the worst is over? I think they reported, the BBC reported this morning that there was 600,000 deaths in the US alone. Asim is saying, yes, you agree with me. Okay, I have one friend here. Thank you, Asim. Yeah, so I think it's reasonable to assume that the worst is over. So then it's reasonable to assume that the Fed isn't going to increase the QE, but there has to be a time, and every day takes us closer to that time when the Fed has to reduce the bond buying. It just doesn't make sense if the economy is doing well and the Fed keeps the rates low. At some stage, they have to start tapering. So this is why we are seeing some USD strength here. But when does it happen? I think Reuters polled something like 60. Reuters polled a number of asset managers, and I think 60 to 70% were thinking that the inflation isn't too bad. Inflation isn't going to cause a major problem, and they kind of believe that the Fed story about inflation being transitory is the right story, the right narrative here that the markets should follow. So that's why you can see the markets being, the market participants being long on oil, and because they just believe that there is still further to go. Yeah, but so I don't think the Fed is going to announce anything major today. If they want to do something about the QE, the bond buying, it is the earliest is going to be in September, but who knows? Who knows what happens? We just need to know what's happening now. Okay, so this was quite lengthy, sort of intro into the USD, but yes, we need to understand these factors. That if you go to TIOmarkets.com/analysis, and I think there it is. Let's take it lower so that others can see. If somebody joins us later, they can also see this. So, these fundamental things, you don't always have to understand them. You just have to read about them and then see if the market is doing what the fundamental ideas suggest. Okay, now we have the Fibonacci retracement levels in place. We have support. So, excuse me, we have some resistance levels there. And then let's see where the nearest supports are. Going down from the current price, there we have a support level. And then obviously the major support at the moment is down here. So the process is, there was a trend down. Now the market is trying to reverse the trend, but it could still move sideways. So I have this whiteboard here. Let's see if I can make this work. All right. So I think what's reasonable to assume now is that the market either moves higher with this new trend, here. So let's go and use a trend channel here. So there we go. I'm connecting these lows, and this tool gives me sort of upper end of this trend also, or sort of estimate where it might be. So I think what's likely to happen now is that the market either retraces lower and then finds buyers and then starts to move higher again. Maybe you can confirm if you see this black line that I've been drawing here. Very bad drawing, actually. That's the best I can do with this mouse. So just confirm in the chat window if you can see this. Anastasia is saying, great nuggets. Thank you thus far. Hey, great. Lovely to hear that I've been able to add some value to your trading also already now. So very good. So, okay. So you can see my weekly line here. So that's one of the potential sort of what's going to happen now. The market tend to fluctuate up and down as they move along. The other option is that the market just keeps on trending sideways here longer. So then that would be a move down, maybe all the way down here. The market breaks below this rising trend line and finds supports here and keeps on moving sideways. That's if the market stays undecided. I think that's another option. Obviously the third option would be a move below the lows, but I don't believe into that at the moment. Basically, based on what I explained earlier, I don't believe that to be the case. But as always, you have to see what the market does. If the market keeps on moving in certain direction, then the market participants as a whole understand something more than you do, or something more than I do, and we just have to be humble. I often talk about market as being the Mrs. Market. I know that in some cultures we have macho men who like to be the head of the family and everybody else listens. But in the markets, even those macho men, if they want to be traders, they have to learn to obey Mrs. Market. So if you want a happy marriage with Mrs. Market, you just have to say, yes, dear. So if you think that you should be buying the market here and the market goes lower, guess what? The market doesn't care. whatever you think. The market takes your money away, and if you don't learn to say, yes, dear, and follow along and start taking dollar shorts here, then you are going to be out of the game pretty quickly. Yeah, so learn to say, yes, dear, to Mrs. Market, and you'll have a very happy marriage with her. Cool. Okay, so now I have some technical tools in place here. Then what else can we learn? We do have, if I take this off, somebody could argue that what's happening here is a triangle kind of formation. Formations is one tool that technical traders have. They try to see where the market is forming something that reminds like a triangle, for instance. These triangles are something that people see quite often. You just have to be careful because human mind is built to recognize patterns. And if you are not careful, you might actually think that you see something, but although there isn't anything, or there isn't anything relevant. But there's a way of basically sort of validating your work. And I'm going to come to that in a moment. Just in case I forget, I'm going to say it now. Actually, it's called confluence, technical confluences. So we need to see if some technical factors come together, and then those kind of validate what we understand is whether it's valid or not. Okay, but back to these formations. So the way to measure or to use formations is basically look at measured moves based on them. They do give you an idea of where the market might be heading to, but not on their own. They give you the idea based on the other context around you. But then if you see the market breaking outside of this, the width of the formation, of this triangle, I mean, here, then the width of the formation often gives you an idea how far the market might move after the breakout. And here, surprise, surprise, the market, this formation width suggests that the market might move to a confluence zone. Here we have 50% Fibonacci retracement, and we have this recent swing high there, and now we have this formation pointing to the same area. So it kind of suggests that this is an important area. Does it make sense this far? Have you been able to follow what I'm explaining? I'd love to see your answers in the chat. Asim is saying great theory, and he's laughing. Yeah, I like this idea of Mrs. Market because I mean, I've seen in some cultures the man walks the fast in the street and the woman follows, but in my understanding with the markets, it's completely the other way around. The Mrs. Market goes fast and you just follow. Okay, Asim is saying yes, Charles is saying yes, Franklin is saying no. Okay, Franklin, I appreciate that we have people from different levels, and people have different levels of understanding and different levels of experience with the markets. So don't feel bad. Actually, if you have anything that you don't understand, feel free to say it. I'm here to help you. Okay, so ask your question, and I'm more than happy to answer the question. Okay, one of the questions might be that why is this confluence area important? Maybe it's something that Jan is saying, maybe he's just imagining that this is important. But I'll give you some reasons why I don't think that's the case. I think this is a valid analysis and valid level of resistance because several technical things point to this level. We have a level that people used. Actually, if we go a little bit further back, we can see that this level attracted some sellers before. So maybe based on this, some short-term traders start to take profits here. Then another factor is this width of the triangle. So again, people see this, maybe not. Maybe the people who see this triangle here don't see this, but it doesn't matter if I'm getting the attention, or if I'm focusing on a level where I have several different groups looking at. So several different groups of traders are focusing on the same area, then that's great, because all the time we have different people focusing on different things in the markets. Everybody has their different time frames. Somebody is looking to buy here to hold it all the way up there. Somebody is buying here to just hold it a little bit and then sell off. Then there are people who are selling here, obviously, because otherwise the market wouldn't have been able to move sideways for the last 2 days. And those people think the market might drop down here, and maybe then they want to engage with this market. Why would that be important, this level here? Basically, it's a level that kind of, a lot of people understand technical analysis, so they focus on this. They focus on these lows here and this trend line. But there's also this 20-period moving average here. So that these two factors mean that I have the attention of 2 different groups here. Then we have, actually here we have a technical confluence as well. Several traders have been focusing on this resistance and this 23.6 Fibonacci retracement and the 50-period moving average. So we have another confluence zone there. Cool. All right. I think that's enough about the dollar, but now you get the idea. You have the Fibonacci retracement, you have the support and resistance levels, you have the moving averages and oscillators. Okay, oscillator I didn't cover. Here's this is something that is it is an indicator that I follow, but maybe I don't give it as much value as all the other things here, because it gives a lot of false signals. Let's rephrase this. It doesn't give enough good valid signals. I mean, there's too many false signals included. So I'm using this as a bit of a highlight, a visual highlight. So if I look at the chart and I see that, okay, we have the stochastics around this level. So I don't think stochastics being here will mean that the market will move lower from here. But I think it's more likely that the market might actually some traders might take this into account, and then other traders might look at these other factors. Cool. Anyway, we spent quite a bit of time on this, but we need to understand the USD in order to understand the other markets. So my apologies for taking so much time with this market, but now once we have this understanding, then we can go to Euro USD and have a much better understanding what's happening here. So now we can move forward a little bit faster. Franklin, I hope these explanations helped you to understand a little more about what I'm aiming to do here. If you have questions, if you have further questions, you can go and email at support@TIOmarkets.com. com. Okay, so, all right, good, lovely. I'm very happy to hear that, frankly. But anyway, if you have questions to me, email support@TIOmarkets.com and ask them to ask the people who read these, the support people. They're a lovely bunch of people. They're very happy to help you out. But ask them to forward the trading questions to me, and I can either get back to you or I can include this in the next analysis, or the answer in the next analysis or the next webinar. Anyway, okay. So because Euro USD has a quite heavy weighting in this basket that is used to create dollar index. And in this, by the way, you can find it in our platform as .dxa. So Euro USD, I think it is about 60%. The weight of Euro USD is about 60% in the dollar index. So what happens in the dollar index is usually reflected in euro as a mirror image. So when you can see that the dollar index is turning higher, you can see that Euro USD is turning lower. So what can we understand about Euro USD here? First of all, we put in, we place the Fibonacci retracements. The market has retraced to 23.6 and it rallied, it came down again, it rallied, it came down again. So we basically have some, okay, this is level already. We have some resistance levels created by these rallies. And then we have, if we go down here, we have the recent key support here. It's up actually, if the market just keeps on going lower, then it's more likely to break this level. But even if it breaks the level, even if a level is broken, then it doesn't mean the analysis was wrong. If you identify a support level, it doesn't mean the market has to turn from the level. It just means it's a level where people used to buy before and they might engage in buying again. But when you do your analysis, you have to kind of try to figure out if the market is actually going to honor these levels. And you don't know that beforehand. Actually, with trading, you know nothing beforehand. So you need to try to think in terms of probabilities. And you need to learn to see how the market reacts to new information. Like today, we have the Fed announcement coming up, the Fed statement, and we have the press conference. So once you hear what they're saying about the future of bond buying program, then you can see how the market reacts. And then you can kind of read into you can start understanding how important those statements are in terms of the market, understanding of those. So what I'm trying to phrase here is that if you see something dollar bullish, something you think that is dollar bullish, let's say that for instance, you hear that the Fed is saying that several members of the FOMC were discussing tapering and saying that it might be time to start tapering now. But then you don't see the dollar rallying. Then you understand that the market doesn't think in a way that, or the market doesn't give the same weight and urgency to that message. They don't think this is actually the most important thing to focus on. There might be something else in the Fed statement that the market is focusing on. So therefore, always see how the price reacts to something that you hear or see happening in the news or in macroeconomics. in the macroeconomic data. Okay, so, but let's go further. Here we have an interesting level. Here we have a low that is clearly a support level, and it coincides with 38.2 Fibonacci retracement. I think if we take, talking about formations, if we take and draw lines here, we can see that the market was moving in a wedge, in a bearish wedge. Basically, it's bearish because it usually means that the market is going to break the lower end and move lower. So the reason these come together and come closer to each other is that the buyers are getting weaker, and there is some institutional buying of the dollar. So the buyers of the euro are getting weaker, and there is some institutional buying of the dollar, and that's why this often happens. So and this is again a formation that you can use. I think that's that should be measured from here. So here we have the width of the formation. And if we take this from the breakout point, it basically points very close to the same area where we have the 38.2 Fibonacci retracement, and we have this low here. So I'd say this is an important area here. And oops. Oh, that's the problem with this platform. If something is active and you press del, everything disappears. Anyway, so let's do a channel analysis here. Take these highs and then this low. And this is interesting. You have yet another technical factor here, coinciding at the same level, 120.44. Let me see. Level is this low here, and that's 120.51. So 120.50 to about 120.60. We have several technical factors coming together there. So that is, if the market drops now, if there is something bullish, dollar bullish and euro USD bearish, then tonight the market might move down here and then bounce. But let's see. If the market rallies from here, then the next important level is here. We have the 20-day moving average and we have the channel high. These coming together at around 2178, so roughly 2180 to 2190. So 2180 to 2190, we have a resistance there. But I guess this is the real test up there. If the market rallies above this channel, then the market really has to find some follow-through buyers to take itself through that level. Otherwise, there's a risk that we just get a move that is something like this. Let me see, where's the pen? There it is. I'm trying to get this whiteboard working. Come on. Let's widen this up a bit first. Yeah, I was saying that this up here is very important resistance level. If the market rallies above the channel and this zone, but then doesn't find enough buying power to get through this level, then I think there's a good chance that the market will just rally a little and then fail again and keep on failing, and then it doesn't make a good case for the bulls. Okay. Let me see what else I had here. And right. It's always good to try to understand where the market might be moving to. If it doesn't, I mean, it's a little dangerous to focus on one side all the time. If you get this idea that the market is bearish, then you tend to fit the facts into what you believe. And that's a little dangerous. And it's actually quite dangerous, because then it means that you are interpreting all the facts through those lenses that you have put on weeks before. So it is good to have two scenarios in mind. The first one might be, okay, there is some bullishness in the dollar. If the market just keeps on making these lower highs in Euro USD, then it's more likely to go down and move all the way down to, say, 50% Fibonacci retracement level, for instance. But it is also worth considering what might be actually happening with the market, and if it tries to break up above the resistances. So where might it actually go after that, and how much? What are the probabilities? And this is something you have to do on a daily basis, because obviously every day you get more information on how the market reacts to certain levels. Now, one thing I haven't mentioned yet is correlated markets. How many of you trade gold? Just a quick answer in the chat window would be nice. How many of you trade gold? Because obviously, if you are trading gold against the USD, then okay, Asim and Franklin are trading gold. Anybody else? Marlon, sometimes. How do you find it? Is it easy or is it difficult? And actually, this brings me to a question that I wanted to ask you guys. What are the things that you find most difficult with trading? What kind of, is it something to do with analysis? Volatility is difficult. Oh yeah. Yeah, you need to be, when the market moves fast, when there is lots of volatility, then it is difficult to trade. I hate gold. Wow. All right. Gold isn't a market that range traders should be trading. There are people who are better in trading ranges, and then there are people who are better in trend trading. Okay, ignoring market manipulation, handling emotions. Yes, emotion is a big one. And I think we need to have a webinar on just trading psychology to cover everything. Actually, now that we are here and touching this topic, how many of you, of all the people that are in here, how many of you are interested in having a webinar where we talk about handling emotions? How to get the grip of your emotions in trading? Because I know it's a lot of trouble for many people. It's one of the reasons, one of the biggest reasons why people lose money. If there is interest in this topic, I'm ready to devote time on building a webinar around it and helping you guys there. And all those people who are watching this afterwards on video, please email support@TIOmarkets.com and let us know if you would like to have a webinar on certain subject, or especially if you would like to have a webinar on trading psychology. Excellent, excellent. Lovely to see that you are interested. Certainly, I love the topic, so we can really sort of dive into it. All right. So let me go a little further back in the chat and see. Yes, volatility is difficult. So if you are a better trader when there is no volatility, then you should basically just have a volatility filter. Say that you don't trade if the volatility is greater than X. And how do you how do you measure volatility is obviously, let's take a 30-minute chart, for instance. There is a way of measuring this mathematically. You can use indicators like ATR, for instance, oscillators, and average true range, or ATR. And sensitivity obviously depends on the periods you choose. Let's use 14 just to illustrate. And here you can see that volatility fluctuates. So the amount of volatility in the market, it fluctuates. So if you are a trader that doesn't like volatility, then you should try to find periods when the volatility is low. Like here, for instance. So if you like to buy the supports and sell the resistances and do some small trading for quick profits, then maybe this is what you need to focus on. And when you get a volatility spike like this, the market rallies higher, then it is more likely that you're going to see more volatility after this also. So obviously every low volatility period, like here, every low volatility period will end at some stage and there will be higher volatility. But what's certain is that once you get a spike higher or a spike lower, there's going to be more volatility after that. So just to, I'll explain this. So when the market moves like this, there's been a quiet period and then it starts to spike higher. Two things happen. Either the market continues higher or the market retraces lower and shoots even further. So, and you can have minor variations of these two, obviously, but once the main idea is that once the volatility spikes, there will be more volatility after that. So if you are a trader that loves to trade inside ranges, then you better make sure the market is ranging and only trade in the range if that's what you are good at. Then there are other people who love to see these volatility spikes and they, for instance, scale into these to reduce the impact of the volatility. And by scaling in, that would mean that a trader takes a short trade there. Let's say that the trader, for one reason or another, has an idea that this move cannot last. So 20% of the risk there, another 20% of the risk there, then, oops, let's move it like this. Then another 20% of the risk, and then, oops, here we go. So that would give you 100% of your risk here. And this is one way of reducing the impact of emotions and volatility. You don't take the full exposure on one go. It's a scale into your position. And that's how you can manage your emotions a little bit, and that's how you can have sometimes better entries. Obviously, there are times when the market just keeps on going higher, or the market just keeps on going lower. So you have to have a stop in place. I'm going to use this as an example. Let's say that somebody scales in here because that somebody believes that the market is going to honor this support. So that trader is scaling in here, and then the market just keeps on going lower. So obviously there has to be a point where this trader says, I'm wrong and I need to get out of this position. And depending on your trading account size, on your trading sizes, and depending on your strategy, you might place the stop here, or you might place the stop here. It really, there is no right or wrong way of placing stops. It really is more about where do you believe, or what do you believe is happening with the market. All right. So this is part of your trading psychology, Marlon. It's if we have too big position sizes, too much risk on the table, then that means that we are likely to experience more emotions, and those emotions are more likely to hamper our trading performance. So in effect, everything is about trading psychology. The more that you understand about the market that you are trading, the more experienced you are trading in the market that you're interested, the better your psychology will be. The more risk you have on the table, say if you have a $10,000 account, what do you think you should be risking per trade in percentage terms? Just give me a quick answer in the chat. How much should you be risking per trade? If you have $10,000 account, you can give me a percentage answer or dollar answer. $100 would be 1%. 500 would be 5%. So what do you think? Okay, while you type in your answers, yeah, Marlon, you can trade in mini lots, which is 0.10 lots. But I'm going to illustrate this with the same chart. Let's say that a trader sells Euro USD, let's say here. The trader thinks that the market is going to go lower, and he's going to sell short 0.10 lots. Then if the market moves up here, he's going to be quite okay. That's 11 pips. If the market moves up here, it's 44 pips, which is still, that's 400 per full contract. That would be 0.10. That would be only $40 risk there. So that's fine also. But the point is that the distance from your entry to, let's say that somebody is selling here at 21.34, 0.10 lots, and then the market moves up to this level, that's $40. That's still quite pretty good. That's still very small risk, and in that sense it's okay. But then we have to ask, it's probably, is it too small? Maybe it is. Somebody's saying 15%, somebody's 6%. Those are very high numbers. If you are risking, obviously, if your wealth is around million or higher, whatever, then 10K, risking 15% of 10K, it means nothing to you. But if 10K is all you have saved over the years for your trading account, and I'm emphasizing here, don't trade the money you can't afford to lose. The money in your trading account should be only the kind of money that you can afford to lose without it impacting your lifestyle. So you can't lose your marriage over this. You can't lose your house or just your sense of well-being because of trading. It doesn't make sense. The money you are putting on the trading account needs to be something that you can lose. So if you can lose 10K, it might be okay for you to lose $1,500. But in terms of trading success, it's not a great idea. Say that you have 5 losing trades in a row. 15 times 5, that's quite a bit, right? That's 50 plus 25. That's 75% of your account gone. So but let me give you a magic number that you often might hear quoted. So you often hear people saying that maximum risk per trade should be 2%. That's a good number because it means that you can lose five trades in a row, which sometimes happens, and you're still down only 10%. All right? It's still okay to start trading again with 90% of your trading account untouched. That's why you need risk management. I would say that if you are a new trader, split this to half. Or if you are a trader that finds it difficult to deal with the emotions, split this to half or maybe even to a quarter of this. And so if you make 10 losing trades and you risk 0.5% per trade, you're still very, very much okay. But if you're risking 15% per trade, 7 to 8 trades, and your whole account is gone. So that's the big rule number one. Like, I think, somebody said that rule number one in trading is don't lose money, right? Don't risk money. Okay. I was going to talk about correlated markets, and this is actually something that I think we're going to finish with now. It's gold is a difficult market because it moves fast, and this is where scaling in might be very helpful to you. All right, so starting from here, we have Fibonacci retracement levels. The market has retraced to 23.6. Does it remind us? It actually reminds us of this euro. Very similar. And you can see, if you look at these charts, you can see how similar they are. Rally higher and then roll over. Euro USD, rally higher and roll over. So if you see something happening in gold, if you think you see something happening in gold, but it's not happening in Euro USD, then you might have to question whether your analysis in gold is right. Obviously, these are both markets that trade against the dollar. So be careful so that you understand the message from different markets. Now, if we take and look at these support and resistance levels, by the way, I think we have to finish soon because we have spent quite a bit of time here already. But I'd like to take one or two markets that you guys are interested in. I think somebody mentioned NASDAQ earlier. So after gold, we're going to take a look at NASDAQ and one other market. So moving down here, we have these key areas or levels that are likely supports and resistances. And if we use the channel tool, we can see that gold indeed is moving in a channel. See how well these lows align with the channel, and we actually used the values that we used for drawing this channel are up here, and still the downside falls in line with these lows. So it's relevant. Obviously, some other people are looking at the same scenarios here. And I think another factor here is that people are focusing on these highs too. See, they used to be, oops, that was a little, let's take that off. So these levels here resisted price move higher for some time. And now 2 days ago, day before yesterday, the market came down to the same area and bounced. So that here is very much a key area now for this market in the future. So if this starts to hold, and I'm going to make this a little wider before I draw. So if this starts to hold and the market starts to create higher lows, then it's quite likely that we'll see a move to the top end of the channel. And then obviously we want to know where the key levels are. We have the 20-period moving average there. We have the channel high there. So I'd say this is an important area. And if this scenario where higher lows start taking place, if that is what happens now and the market doesn't break this support, I think people might start taking some of the profits off around this level. So you just might want to, if we get a rally there, I can't tell you that the market is going to turn lower from there, but I'm thinking maybe some of the money comes off the table as people start taking profits. So you have to be aware that the market might get weak up there. If the market starts to roll over, comes to this level and starts to roll over, then that's a different question. Then obviously we have evidence that the buyers are willing to step in up here, and then we would have more bearishness ahead. Then the other option is that we're gonna have, because it's the FOMC day, if there are surprises in the way that the Fed speaks, and then okay, Asim is asking a simple question. Let me address this quickly. Asim asks how to add those moving average lines. You go to insert indicators and then to trend, and here you can choose moving average. Let me see where it is. That's the adaptive moving average, and the simple moving average is, why am I not seeing it now? Williams volumes, triple, exponential, average, adaptive average. It's usually here. It's usually on the top. Okay, for some reason, I just don't see it now. But it's basically the same. When you find it in your platform, it's just click on here and it gives you the box where you can change the settings, and you click OK, and it appeared up here. So I'm going to make this a different color and wider so that we can see what we added. Okay, so there is the adaptive moving average added to the chart. And interestingly, it has been a resistance there, and it is coinciding with this same zone that I just drew. Very interesting, isn't it? So that adds to the value of this area being a potential resistance area. But I was going to say that because it's the FOMC day, we might see the market being a little volatile. So I wouldn't be surprised if, oops, no, that's bad. If something like this happened. And obviously, if that happens, you don't want to be trading because it's kind of very, very difficult to know where to enter and exit if you don't know what you're doing, right? If you want to try on a demo account. Okay. So basically, this is the first scenario. The market starts to move higher. Some money might come off the table up there. The other scenario is that we get a move lower. We break the supports and we just keep on moving lower. That's obviously another possibility. Can somebody tell me, please, what if the Fed starts tapering? How's that going to impact, based on what you have learned today? How is that going to impact the dollar? And how is that going to impact gold? We don't know exactly, but we can make guesses. So is the dollar going to move higher or lower if the Fed says we have been discussing tapering and we are thinking of reducing the QE? Asim is saying positive, bullish for dollar. Is anybody taking the other side of the trade? Does anybody disagree? Okay, nobody disagrees. Yeah, that would be positive. That would be bullish for the dollar. And then Asim is saying it's gold bearish. Yes, that would be. And the main reason is that because when you trade gold, and it is, if you look at what we are trading here, this is XAU USD. It is gold against the dollar. So when you're buying gold, you are selling the dollar, right? If people are very bullish on the dollar, then that should send the gold down because it's an equation. If the right-hand side of the equation, the USD, gets stronger, then the value of gold diminishes in the USD when measured in the USD. Yeah, very much depends on the big players, but the big players fear what the other big players might do. So they wouldn't fight against the Fed. The Fed is the 800-pound gorilla in the room. So if the Fed says we are going to stop buying the bonds, then the interest rates will go where? What happens to interest rates if the Fed stops buying the bonds? The bond prices go up when the Fed is buying in order, or the Fed is buying in order to bring the interest rates down. Yeah, so there's the invert relationship there. So if the Fed stops buying the bonds, the interest rates will go higher, and that will attract buyers in the USD. Cool. Anyway, let's go and see what's happening with NASDAQ. And like I said, I can take one more market after that, and then we are done for today. Let me see, where is NASDAQ here? Just a moment, please. All right. Come on. There's too much here now. I'm gonna have to hide all and then add NASDAQ. There we go. All right. So here we have the technology index NASDAQ, or to be exact, this is a CFD that tracks the index, and therefore the prices are a little different compared to the futures, but basically you get the same price action really, so it doesn't make a difference. It's easier to trade NASDAQ CFD than the futures because you don't have to put up so much money. All right. So with NASDAQ, I'm basically doing the same as with all the other markets. I'm looking at, to get an idea where the market is at, well, obviously, and where the key levels are. I always start with the Fibonacci retracements. I'm taking a prominent low here, and I draw these levels to the latest high with the assumption that, you know, somebody might say you don't know if the market is going to retrace from here. Obviously, I don't, but if it does, I want to know where the key levels are, where the confluences are. Now, if the market decides it's time to trade lower after the FOMC, then we have the 23.6 Fibonacci retracement, and we have both the moving averages, 20 and 50, coinciding with a level that used to be a resistance here. So I would say that's a pretty interesting level there. If the market drops there, what do you think will happen? So maybe the market trades down here and bounces higher. That would be my guess. If the market retraces lower, I think there's a big likelihood that the market bounces from this area because there are so many technical factors coming together here. Okay, some other people might be looking at this latest low here and using the Fibonacci retracement levels a little differently. And again, we have 38.2% retracement level coinciding with the same level here. Let's go and use the channel tool. And oops, sorry. Here we go. So the channel low is a little higher than this area here, but still, I'm pretty happy with these factors coming together. And if I see the market bouncing, I think that makes sense to be on the long side there. But again, this is not investment advice. I have to remind you guys that we don't provide any investment advice. This is only for educational purposes. And if you are thinking of using this analysis, you have to make sure you understand, you have to make sure it agrees with your own analysis. Just don't do something because I see that this is a possibility. And I'm not saying market will come down here and there will be buying. I'm saying the probabilities are that this is a key area because of these technical factors. And if the market reacts to this, then the market confirms my thesis. I don't know anything beforehand. That's something that you should remember. Yes, the red one is 20 and the 50 is blue. All right. Then the other scenario is that the market just comes down here, market fluctuates a little, comes down here, rallies a bit, and then goes through. That would be actually quite bad. It would mean that the market isn't really liking what the Fed is going to do, and we might see the market moving further down, maybe to these lows, maybe to these lows here. All right. And just to save time, I'm going to go to USD MXN. This is a market that I usually don't trade or analyze, so it's a new market to me, but it's interesting, so I'm accepting the challenge. Sorry, there, this one. Okay. So, as usual, let's pull in the Fibonacci's first. And we can see that the market has been finding resistance here. What else? We do have, let me place some levels to, yeah, okay, this is level already. So obviously this is interesting. The next one is up there, and then the one before that is quite far. But the key levels are, the key resistance levels are up there, and the key support is down here at the moment. So this is the likely fluctuation range for the USD Mexican peso. This is a volatile market. It can move quite a bit. Let's see, this wide range candle here was 1%, so that's a decent move. But if you go back in history, you can see that this market really can be highly volatile. If there is a crisis going on, like a year ago in the springtime, one candle range could be 7.2%. That's something you don't want to trade unless you are highly experienced. Okay, I think we have a ranging market here. We do have let me actually, I'm going to use the channel tool so we get the nice red color. Here we go. So we have a bit of range, but we also have some weakness here. So the market has been banging its head against the upper end of the channel, but these moves have been rejected. So that suggests that the market could fluctuate a little more and then come down again. That's 1% potential scenario. Based on what I see here, this is possible. But then again, there was quite a bit of momentum here, and we are fairly low in this big range. So it is also possible that the market participants will find reasons to buy this market and move higher, especially if the Fed says that we are looking to taper. That's then the USD would be moving higher with the other USD pairs or against the major USD counterparts. Lovely. Thank you, guys. It's been very interesting looking at these markets with you, and I really love your questions. If you have something more, please go to the support, email support at TIOmarkets.com, and they will forward the questions to me. Then I can take these questions and look at them, maybe incorporate them into your future webinars. And while I'm looking, I'm actually going to give you the promo code. Yeah, Asim, I haven't forgotten that. Yeah, I'm going to give it to you now. But while I do this, please take a moment and give me a grading on this webinar. I need some feedback from you. If you think the webinar wasn't really good, give me 1. If you think the webinar was excellent and very good and very helpful, give me 5. So anything from 1 to 5 that sort of suits your or tells me what you think you got out of this webinar? Obviously, 3 is very uncommittal. It doesn't tell me anything, but one number in the chat box. Is it 1? Is it 2? Is it 3? Is it 4? Is it 5? And after that, I can give you the promo code. I'm waiting, guys. Grading 1 to 5. And let me find the promo. Hey, thank you. Lovely. Everybody's giving me 5s. High fives, guys. Hey, that's good. Really nice. Because that really makes my day. If I'm able to help you guys, it means that I've done my job right. Excellent. Yeah, you need to become an independent trader, Asim. I agree with you 100%. But these concepts that I've now shown you, allow yourself time. Don't expect to be a master in everything that you have learned just overnight. It takes time. You need to let things solidify in your thinking. Your subconscious needs to go through these. And I would suggest take these concepts, go back in charts, use the historical prices and do analysis and see how the market moved after your analysis. Okay, thank you, Mary. Lovely. Thanks for the 5. Very good. Excellent. Cool. So here's the promo code, and I'm calling it a day now. So it's basically, it's been lovely to spend time with you. And if you haven't done so yet, you might want to subscribe to our Telegram channel. And I'm going to give you the link to the channel. Just a moment. Where's the channel info there? Okay, so if you go to this Telegram channel, you get an alert each time there is new analysis available. So it helps you immensely. Thank you, Izzat. It was really nice to be able to help you guys. And if you like the webinar, please tell your friends and invite them to the next webinar so that they can learn also, because obviously we want to help as many traders as possible. Lovely. Thank you for your time, and I certainly look forward to seeing you soon again.